In September 2008, the United States Treasury Secretary sat before Congress and told them the truth. The global financial system had roughly 72 hours before it stopped functioning entirely. Not slowed down, not struggled, stopped. No one outside that room fully understood what that meant. Most people were still watching the news, wondering why their retirement accounts were falling. A few were beginning to lose their homes. Almost nobody understood what had actually broken, or how long it had been breaking. This is the story of how the most sophisticated financial system in history quietly built the conditions for its own collapse, and how, when it finally gave way, the damage spread to every corner of the world. Welcome to Forgotten Economy, where the systems that shape our world are finally explained. To understand 2008, you have to understand what the years before it felt like. The early 2000s in the United States were a period of unusual confidence. Interest rates were low. The economy had recovered from the dot-com crash, and one investment above all others seemed to carry almost no risk at all: housing. American home prices had been rising for decades. There had been regional dips, occasional corrections, but no sustained national decline within living memory. This created a quiet assumption that had embedded itself deep inside the financial system. Housing prices, as a national average across the United States, simply did not fall. Banks lent on that assumption. Investors built on it. Regulators allowed it. And millions of ordinary Americans made the largest financial decisions of their lives based on it. Between 2000 and 2006, home prices in the United States rose by more than 70%. In some cities, they doubled. New construction accelerated. Mortgage lending expanded rapidly, and the demand for home loans began to outpace the supply of creditworthy borrowers. That gap was about to be filled in a way that would prove catastrophic. When demand exceeds supply, systems find ways to stretch. The financial system stretched by changing who could get a mortgage and what happened to that mortgage afterward. In the older model of banking, a lender issued a mortgage and held it. The bank had a direct interest in whether the borrower could repay. If the borrower defaulted, the bank absorbed the loss. This created a natural discipline. That model was gradually replaced by something different. Banks now issued mortgages and then sold them, packaging them into large bundles of loans that could be sold to investors around the world. These were called mortgage-backed securities. The investors received the stream of monthly repayments. The banks received fees and moved on to the next loan. This created a problem that was not immediately visible. The bank that issued the mortgage no longer bore the risk of default. That risk had been passed to someone else. And when the incentive to assess risk disappears, the standards for lending tend to follow. So lenders began issuing mortgages to borrowers who, under older standards, would never have qualified. Loans with no income verification, loans with no down payment, loans with low introductory rates that would reset sharply upward after 2 or 3 years. These became known as subprime mortgages. The loans were then bundled, rated by credit agencies that often assigned them investment-grade status, and sold globally. Pension funds in Norway bought them. Banks in Germany held them. Insurance companies in London carried exposure to them. The risk had not disappeared. It had simply been dispersed so widely that no one could see where it had gone. The first cracks appeared in 2006. Home prices in several American cities began to plateau and then decline. The construction boom had produced more housing than demand could absorb, and borrowers with adjustable rate mortgages began to feel the pressure as their introductory rates expired and monthly payments climbed. Default rates on subprime loans began rising, quietly at first, then with more urgency. In February 2007, HSBC, one of the world's largest banks, announced losses tied to American subprime mortgages. It was an early warning that few fully absorbed. That same spring, more than 24 subprime mortgage lenders in the United States went bankrupt. The market for these loans began to freeze. By the summer of 2007, 2 hedge funds managed by Bear Stearns, that had invested heavily in mortgage-backed securities, collapsed entirely. Bear Stearns told investors the funds were worth essentially nothing. It was a significant failure, and it signaled that the assumptions built into these securities were fundamentally wrong. Yet the broader financial system continued operating. The damage seemed contained. The Federal Reserve began lowering interest rates to ease the stress. Officials spoke of resilience. The word subprime entered public vocabulary, but was still widely understood as someone else's problem, a niche corner of the mortgage market with limited wider implications. That understanding was incorrect. By early 2008, the crisis had grown considerably more serious. In March, Bear Stearns, the same bank whose hedge funds had collapsed the previous year, ran out of the short-term funding it needed to operate. Over a single weekend, the Federal Reserve arranged an emergency sale of Bear Stearns to J.P. Morgan Chase. The transaction happened so quickly that most of the public barely registered it. The system had bent, but it had not broken. The assumption held that the government would not allow a major financial institution to fail outright. That assumption shaped how banks, investors, and regulators behaved through the summer of 2008. It was wrong. On the evening of Sunday, September 14, 2008, Lehman Brothers, one of the oldest and largest investment banks in the United States, filed for bankruptcy. Attempts to find a buyer had failed. The government had decided, for reasons still debated, not to intervene. The effect was immediate and severe. Lehman had financial connections running through virtually every major institution in the world. Its collapse created uncertainty on a scale the system could not process. Banks normally lend to each other constantly to manage daily liquidity. After Lehman, that lending nearly stopped. The short-term lending markets that financial institutions use to fund their daily operations froze almost overnight. Credit stopped moving. In the space of days, what had been a serious but manageable crisis became something else entirely. The financial system is, at its core, a network of promises. Banks promise to repay depositors. Borrowers promise to repay banks. Institutions promise each other that the collateral backing their transactions is worth what it appears to be worth. When those promises hold, the network functions. When they break, the damage moves fast and does not stop at borders. In the weeks following Lehman's collapse, the panic spread globally. Banks in Europe that held American mortgage-backed securities found themselves unable to determine what those assets were actually worth. Institutions stopped lending to each other because no one could be certain who was solvent. Money market funds, considered among the safest investments available, began to show losses. Ordinary investors, who had no reason to understand what a credit default swap was, found their savings falling rapidly. In Iceland, the entire banking system collapsed within days. 3 major Icelandic banks had borrowed aggressively in international markets and were now completely unable to refinance their debts. The country's currency fell sharply. Its economy entered a severe contraction. In Ireland, the United Kingdom, Spain, and across the Eurozone, institutions that had purchased American mortgage-backed securities discovered the losses were real and substantial. Governments that had been operating on assumptions of continued growth suddenly faced banking systems that required enormous support simply to remain functional. The crisis had crossed every border that anyone had assumed would contain it. Governments faced a decision with no good options. Allowing major financial institutions to collapse would deepen the crisis further. The interconnections were too dense, the uncertainty too great. But rescuing them meant using public money to cover the consequences of decisions made by private institutions. Decisions that had generated enormous profits for those institutions in the years before the collapse. In the United States, the Treasury proposed a program to purchase troubled assets from banks. The Troubled Asset Relief Program, known as TARP, was initially rejected by Congress. The vote caused the stock market to fall nearly 800 points in a single session. Congress passed a revised version days later. The government ultimately committed hundreds of billions of dollars to stabilizing the banking system. The Federal Reserve moved simultaneously, taking unprecedented steps to provide liquidity to financial markets. It cut interest rates to near zero. It began purchasing financial assets directly, a policy known as quantitative easing, effectively creating new money to support a system that had seized. In Europe, governments moved to guarantee bank deposits, inject capital into failing institutions, and coordinate with central banks to prevent a complete breakdown in credit markets. The measures worked, in the narrow sense that the system did not collapse entirely. But millions of people lost their jobs, their homes, and years of accumulated savings. The economic contraction that followed was the most severe since the Great Depression. Recovery was slow and uneven. In some countries, it took more than a decade to return to pre-crisis levels of output. Financial crises tend to produce regulation. This one was no exception. In 2010, the United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, the most significant overhaul of financial regulation since the 1930s. It required banks to hold more capital as a buffer against losses. It established new oversight of the derivatives markets that had amplified the crisis. It created the Consumer Financial Protection Bureau to monitor lending practices. And it introduced stress testing, regular assessments of whether major banks could survive a severe economic shock. Similar reforms followed across Europe and in international regulatory frameworks. The Basel III Accords raised capital requirements for banks globally. The assumptions about acceptable risk that had governed the pre-crisis system were revised substantially. The mortgage market changed too. The loosest lending practices disappeared. Income verification returned as a standard requirement. The era of no documentation, no down payment home loans largely ended. And yet, the deeper questions remained open. The financial system that emerged from the reforms was more resilient in specific ways, but it was also more complex, with risk migrating toward less regulated corners of the market. The institutions that had been too large to fail in 2008 were, in many cases, larger afterward. What 2008 revealed was not simply a failure of individual institutions or individual decisions. It revealed something about the nature of the system itself, how risk can be dispersed so widely that no single actor feels responsible for it, and how assumptions held long enough and by enough people can become indistinguishable from facts, until they are tested, often all at once,